Ladies and gentlemen, good day and welcome to the Q3FY22 earnings conference call of Catholic Syrian Bank, hosted by Axis Capital Limited. As a reminder, all participant lines will be in listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Praveen Agarwal from Axis Capital. Thank you, and over to you, sir.
Thank you, Stephen. Good morning, everyone, and welcome to this earnings call. From the management team, we have Mr. CVR Rajendran, MD and CEO, Mr. Pralay Mondal, President, Retail SME Technology and Operations, Mr. BK Divakara, CFO, and Mr. Ganeshan V, Head of Credit Monitoring and Recovery. And we also have few other members of the management team, like Anthony, Srilata, and Rajesh. So I would request Mr. Rajendran to share his initial remarks on the results, and then we'll take the Q&A. Over to you, Mr. Rajendran, please.
Thank you. Very good morning, and since this is our first interaction in 2022, let me start by wishing you all a very happy New Year, rather a virus-free New Year. While the economies were gradually recovering from the COVID shock, now we are witnessing a rapid surge in infection due to the Omicron variant. The fact that we have progressed well on vaccinations and the reports that the infections are less severe with a lower need for hospitalization gives us some respite. For the domestic economy, the prospects are bright, as evidenced by the increasing demand, good agricultural production, uptick in bank earnings, etc. The regulator's decision in continuing with the accommodative stance will support in reviving and ensuring sustainable growth in the country. So let us be optimistic that this quarter will be one of action and results. Now we started this financial year with some portfolio stress, especially in gold loans consequent to the reversal of high LTV regime. We have been consistently improving in the recovery from quarter on quarter, and Q3 is of no exception. If you remember, in Q1 Concall, I had told that the worst will be over on NPA front by Q3, and happy to note that gross NPA percentage is now lower than that of 31/3/2021. Our considerate approach towards the problems of gold loan customers, giving them breathing time to repay the loan, was beneficial to both the customer and the bank. Once the COVID situation improved, the customers' earnings also improved, enabling them to repay the loan and get back the jewelry, which had a sentimental value attached to it. Though our gold loan NPA for quarter 1 was 6.45%, comprising of 22,879 accounts, amounting to 353 crores, we resorted to auction mode only for 387 accounts, with an approximate value of rupees 9 crores, and private sale was conducted for 4,215 accounts involving a quantum of rupees 85 crores. The total deficit amount is about rupees 9 crores, which has been fully provided for, and recovery process is through. This is treated as an unsecured loan in our books. We expect that we have chance of fair recovery from these accounts based on our past experience. On the other hand, the delayed auction sale benefited the bank by way of recovery of interest income to the tune of 11 crores in the current quarter. This quarter has also witnessed credit growth, including in our mainstay business of gold loans. We could record a year-on-year growth of 11.42% in net advances and 22.14% in CASA. Gold loans also have started to move up, posting Q-on-Q growth of about 7%. Coming to profitability, Q3 continued to be a robust quarter, registering a growth of 179% year-on-year quarterly basis and 87% for the 9 months period ended 31/12/21, vis-à-vis the corresponding period last year. We could post a quarterly profit of rupees 148 crores, vis-à-vis 53 crores in Q3 of financial year 2021. and 119 crores in Q2 of financial year 22. The net profit for 9-month period ended 31/12/2021 is 328 crores, vis-à-vis 176 crores for the corresponding period of last financial year, thus surpassing the full financial year profit for financial year 21. Let me now take you through the main highlights of the published results. Quarterly NIA has crossed the 300 crore mark for the first time in the bank history at 303.34 crores. It is 9% increase from the previous quarter number of 278.38 crores. This has contributed by both spread and volume gain. Spread gains is manifested in NIM, improving by 25 basis points, 5.46% from 5.22%. While on volume front, our average advances have grown by 5%. Yield on advances have improved from 11.38 to 11.59, or by 21 basis points, contributed mainly by recovery of interest on gold loan NGS, while cost of deposits have been flat. 9 months to 9 months, NIA has shown a growth from 666 crores to 849 crores, or by a robust 28%, aided by improvement in average CD ratio from 72% to 75%, increase in yield on advances from 10.90% to 11.20%, and decrease in cost of deposits from 5.18% to 4.34%. So the yield on advance has gone up by 30 basis points. The cost of deposit has come down by 72 basis points. That helps us in expanding our NIM and net interest income. Non-interest income, decent market has been unidirectional, giving the global scenario of increasing yields and heightened inflation combined with the domestic scenario of improved growth and reignited consumer price inflation. This gives little room for treasury profit booking, which was a key contributor to the kitty loss financial year. Thus, while we could book rupees 118 crores of treasury profits in 9 months of previous year, the corresponding for the current 9-month period is only 13 crores. It is down by 105 crores. But we could compensate it from other non-interest income streams to a great extent, as the same surged from 121 crores to 170 crores, or by 9% on a 9-month basis. We had front-loaded the PSLC premium booking in the first 2 quarters in the financial year, booking 12.5% in the quarter 1 and 13.9% in quarter 2 of financial year 22. As there was no more such booking in quarter 3, non-interest income ex treasury profit has decreased from 70 crores to 51 crores. Staff cost, Q2 to Q3 staff cost has increased from 119 crores to 122 crores. The increase has been contributed by increase in AS 15 provisions from 38 crores to 40 crores due to increase in DA to pensioners. While headcount has decreased marginally from 4,870 to 4,845, with IBA scale employees decreasing from 1,436 to 1,391. On a 9-month to 9-month basis, staff cost has increased from 318 crores to 338 crores, or by 6%, while headcount was increased from 3,970 to 4,845, or by 22%. AS 15 provisions have decreased from 116 crores to 95 crores on a 9-month to 9-month basis. Other office has increased from 70 crores to 86 crores sequentially due to shortage in micro enterprises lending. Target Bank has purchased PSLC certificates paying rupees 12 crores, which is the main contributory to the surge. On a 9-month to 9-month basis, other office has increased from 152 crores to 222 crores. The increase has been contributed by increase in rent to the extent of 11 crores, depreciation to the extent of 8 crores. Number of branches have increased from 448 to 559 on a 9-month to 9-month basis. first 9 months, if you look at it. We have opened 111 branches during this period of time. Operating profit are almost flat on Q-on-Q basis and is at 148 crores for Q3 of financial year 22. CSB premium had a total negative impact of 33 crores on operating profit, with other income down by 21 crores and other OpEx up by 12 crores. On a 9-month to 9-month operating profits have increased from 435 crores to 472 crores, or by 8%, despite treasury profits down by 105 crores due to robust growth in core income. Cost income ratio has increased from 56 to 58.5% Q-on-Q on a 9-month to 9-month basis from 52 to 54%. Net profit has increased sequentially from 198 crores to 148 crores Q-on-Q. There has been rupees 52 crore net reversal in NPA provision in Q3 of 22, powered by NPA recovery on both the gold and non-gold portfolios. Despite this reversal, provisioning coverage ratio has improved from 73% to 83%. Thus, despite reduction in operating profits, a bumper recovery of stress assets have enabled higher net profits. 9 months to 9 month net profits have increased from 176 crores to 328 crores, or by 87%. Return on asset has increased from 2.02 to 2.43 Q-on-Q, and return on equity from 23% to 27%. On a 9 months to 9 months, return on assets have increased from 1.07 to 1.83, with return on equity from 14% to 21%. As far as asset quality is concerned, it was a prominent quarter in terms of NPA recovery, where we could contain both gold as well as non-gold NPAs. Out of gross NPA of 388.95 crores, 102 crores is gold NPAs with higher recovery. In fact, more than 25 crores of recovery has happened in the 102 crores during the 21 days so far in the current quarter. Gross NPA, net NPA ratios have improved to 2.62 and 1.36 as on 31/12/21. 2.62 GNPA, 1.36 at NPA. It is from 4.11 now, 4.11 and 2.63% respectively on 39/21. Gross NPA, net NPA ratios, excluding gold, was out to 1.87 GNPA, 0.85 as net NPA as on 31/12/21. Capital adequacy continues to be comfortable at 20.74% as on 31/12/21 as against 20.12% as on 39/21. This year, we were to reckon the 9 months profits of 328 crores as part of capital funds. The CRAR would be 24.5%. This shows that we have ample scope to grow the balance sheet and further improve return on equity without any further infusion of external capital. We have opened 53 branches in this financial year so far and merged 6 unviable branches, thus taking the total network to 559, branch network 559. Considering the present state of affairs and slightly longer than expected time taken by the new branches in attaining the break-even business, we will not be as aggressive in the last financial year in branch expansion. However, we have plans to open another 30 to 40 branches in the current quarter, for which work is on. Since the outbreak of pandemic, we have been following an accelerated provisioning policy for stress assets, that is NPA and SMA accounts, other than gold, including those having 1 day default. The same was followed in the current quarter as well. However, as many banks have started reversing the extra provision, let me also give you a summary of our pro forma results as per the RBI provisioning now for enabling better comparison. Apple to apple basis. If we had reversed the accelerated provisioning amount of 235 crores, consisting of 131 crores of provisions for additional provisions for NPA or accelerated provisions for NPA, and 104 crores of provision for standard assets. When drawing the balance sheet of 9-month period, our net profit would have been 504 crores, up by 176 crores from the declared profit. The profit is only 174 crores. Net profit could have moved to 504 crores. Our pro forma, which is published ROA and ROE, are 2.81 instead of 1.83, and 30.59 should have been the return on equity instead of 20.88, which you are declared. Pro forma EPS and book value per share would have been 38.83 and 146, as against the published value of 20.27 and 136. Pro forma CRAR, including 9-month PAT, works out to 26.43. On asset quality, without acceleration, the NNPA works out to 0.24 and PCR at 71.77%. Both the ratios are still better than the industry averages published in the RBI FSR report. The details will be summarized in the document to be published in the website. And the tabular format is also presented. This will be available in our website. Earnings guidance. Normally we don't give guidance. A lot of calls were there yesterday about the sustainability of the net interest margin. Thus, quarter after quarter, we were telling that net interest margin may not be sustainable at this level. Our targeted net interest margin is above 4.5%. That is a statement which we made to the investor, but internally, we were chasing every possible way to get better return on equity and return on assets also. What could be the drivers for this net interest margin expansion? For the past 5 quarters, we have been able to maintain NIM of about 5%, and this is the new normal. Given that the current quarter NIM indeed was benefited by recovery of gold loan interest by around 11 crores and increase in standard gold loan portfolio by 504 crores, it may be noted that even Q1 financial year 22, when we were seeing hard by gold loan NPA and interest reversal, we could maintain a NIM of 5.04%. I'd like to elaborate on the future drivers of NIM. Improvement in treasury yield. You would have noticed that our yield on investments has come down from 7% in Q3 financial year 21 to 5.54% in Q3 of financial year 22, or by 146 basis points. This is mainly because we have invested in the corporate bonds after borrowing the money from TLTRO. We have booked a profit on these corporate bonds in the quarters, and we have replaced this investment with the T-bill. As we took a call that interest rates are likely to open further, we have unwound our position in the long-term paper and converted everything into T-bill. Today we have 2,659 crores, 2,659 crores deployed in treasury bills, yielding around 3.5% as on 31/12/2021. We have around 1,000 crores of headroom available in HTM that can be filled by long-term paper, and we plan to do so by shifting from T-bills in a phased manner, as we are now seeing increase in long-term rates by the day. As we will be looking at yields above 7%, there will be an incremental spread of around 3.5% on such shifting. Also, we are seeing credit growth picking up in Q3 and expect the same to sustain in Q4 also. We will be funding the incremental credit at an opportunity cost as low as 3.5%. Now coming to the improvement in the yield on advances, we could increase the yield on advances from 10.98 to 11.59, or by 61 basis points on Q3 to Q3, even in an interest rate falling environment. This is the large extent due to high proportion of gold loan in our total portfolio. Going forward, as liquidity dries up and risk pricing comes back to the front, we will be able to increase yield on our SME book also. Similarly, we have significant unavailed limits on corporate loans, direct assignment, and PTC side, and we can also the effect of better pricing and availment in future. Even in gold loans, there is still scope to increase the yield as repricing will happen in the product where we are now getting only 7% with industry service to budget. Then again, the third driver could be low duration of the asset book. Our modified duration of our total book, our total asset book is around 1 year, including the investments and the loan book. Our asset book duration is only 1 year, and this makes us perfectly placed to face upward sloping yield curve. Fourth driver could be decrease in the cost of deposits. Our ratio has improved to 35% this quarter, and more importantly, we are able to maintain cost of savings deposits consistently at around 2.50% to 2.65% level. This may not be the case for many banks who have attained the growth in savings deposits portfolio at cost above 5%. There is scope for further reduction in cost of deposits from a different source, short-term deposits. Right now, short-term deposits or deposits of original maturity less than 1 year constitute a mere 7% of our total term deposits. While for many banks, it is above 50%. We have now formed a separate team targeting institutional clients, boost of such deposits. It will help to improve our overall cost as such deposits will be costing as low as 4% in the days to come. Cost income ratio has been one area which requires improvement as for the 9 months in the December 22, it is 54% as against 52% of the comparable period of the last year. Reduction in treasury from 118 crores to 13 crores has contributed to the increase, and we could make good the reduction to a great extent by growth in core income, net interest income and commission income. In coming quarters, we will be able to improve further on the core income as we are sitting on a huge unused capacity. Our business per branch is only 60 crores, while our case it is in the range of 150 to 250 crores. Given our capital adequacy quotient, we can easily double our balance sheet and still maintain comfortable CRAR without any external capital infusion. Also, the 150 odd branches we have opened in the past 2 years do not have any legacy issues, and most of them, especially those are growing exponentially without adding to the cost. Credit costs have been negative continuously for the past 2 quarters, while for the 9 months 22, it is only 0.26%. As for sustainability, it may be noted that we have a provisioning policy whereby we provide a NPA fully in a matter of 3 years, even if it is secured. We could post significant recoveries in on-board NPA as well, though the environment was awesome conducive. Going forward, given the secure nature of most of our NPAs in SMEs, we think credit cost of near zero level will be sustainable. Return on asset and return on equity. 9 months return on asset has been 1.83 and 9 months return on equity is 21%. Given the scope for further improvement in NIM and income and the ability to contain credit cost, we think this will be sustainable. Over to you for your question.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Mona Khetan from Dolat Capital. Please go ahead.
Hello.
Yes.
Yeah, hi sir. Good morning. So my first question pertains to the processing fees. So sequentially, despite the healthy growth seen, our processing fees has come down. So what exactly leads to this?
Excess liquidity is a drain on the resources. We were fighting to reduce the excess liquidity in all possible manner. If you have excess liquidity and deploy in the government securities today, interest rates will go up and you have to bear the depreciation. And the credit market is not picking up, it is much. the prices are very low, or risk is not getting priced properly. So our call was not to accept the call, if it is possible. We cannot put a full stop to the retail deposit. We continue to accept the retail deposit at a very low rate. Our rates are as low as any other major market. And we don't compete in our market. Our market, other competitors are paying a higher rate. And in the bulk deposit market, wherever we have a relationship, a strong relationship, we continue to accept the bulk deposits at the call rate. But of late, we took a call. Even at call rate, we will not accept the bulk deposits, even from our existing clients, because there is no possibility of deploying them. So we requested these clients to shift their account, to shift these deposits elsewhere where they earn more. And as a result, even the bulk deposits have come down over a period. So today's CD ratio is almost 78%, and confident by March end, it will be somewhere between 82 to 85%. Without raising further resources from the deposits market, retail deposits market, I can take the CD ratio as near to 100%. There are many refinances available at a cheaper rate. My CDs will be raised at a much cheaper rate than the deposits. I have CD program approved for 2,000 crores. I can enhance it. And the term money and other money market instruments are also there to raise the money at a cheaper rate. We can go for foreign currency borrowing if the landing cost is cheaper than the domestic borrowing. So we continuously explore all these possibilities and take the liabilities which are the cheapest. As a result, liability cost is coming down from 7.85% deposit cost. We already brought it to 4.34. I am confident it will go below 4%. So liquidity is not a problem at all. Unlike other banks, where the asset book duration is very large. That is what I was explaining. If you are deployed in the infrastructure, if you are deployed in the retail loans, consisting of housing loan and mortgages, and if you are invested in the term loans, then naturally your asset book duration is more. You have to write a long-term liabilities. Whereas in my case, my asset book duration is only 1 year. And if 50% of my book consisting of the T-bills and the gold loans, average maturity is only 4 months. So naturally, I am placed in advantageous position to raise the short-term deposit at a low rate. Today, your liquid funds are not giving great returns. Okay, it's around the T-bill rate today. So instead of the 3.5% T-bill rate, even if I offer 3.75, I will be in a position to raise huge amount of corporate deposits in the short-term market. The focus for the next quarter, 2 quarters will be to increase the proportion of short-term deposits in our liability portfolio. Otherwise, liquidity-wise, we are very comfortably placed. Having 200% liquidity ratio is not the right strategy. It doesn't give return to the investor. What the regulatory requirement is only 100%, we are at 154%. In my opinion, that itself is inefficient. So we will improve the efficiency and bring it to little more than the required level to provide comfort to the regulator.
So, sir, I was referring to the fee part, which in my opinion is not linked to liquidity as such. So your processing fee, the non-treasury related income has declined. So the total fee is still higher from 32 crores to 33. But within that, the processing fee component has come down despite the rise in loan book. So that was my question.
So there also what happens, one fee income which has gone down is priority sector certificate sale income. Okay, that we had 32 crores in the first 2 quarters, which is not available in the third quarter. On the other hand, we had to purchase the priority sector. It became an expensive item, but otherwise there is no income from that. As far as the processing fee is concerned, today because of the excess liquidity conditions prevailing in the market, there is concession in everything. There is concession in the processing fee, there is a concession in the rate of interest charge, there is a concession in the premature process charges, everywhere. So naturally, the fee income related to the gold book as well as the gold loan, they are completely waived the processing fee. So as a result, the ability to collect process fee is very low when there is a liquidity surge. I think that is getting addressed now. over a period this will come back. But overall, my non-interest income is higher than the last 9 months, in spite of the fact that treasury income has gone down by 105 crores.
Sure, got it. And you highlighted a couple of levers for margins going forward. So is it fair to say that your margin guidance or outlook from the 4.5% given earlier, it will be higher at, say, closer to 4.95% or so?
I won't make a statement like that because it may be against the guidelines. I cannot give a forward-looking statement. What I was trying to explain is that we have so many levers available to us which will effectively relate to improve the NIM further. There could be other factors which may pull down. As of now, these are the levers available to us which may help us to improve the NIM even over the present level. That is what I was indicating.
Sure. And what is the write back owing to recoveries seen in this quarter in the interest income?
The current quarter we are expecting a robust recovery, both in gold loan as well as non-gold loan. Gold loan is only 126 crores in the year end, which has come to almost 85 crores as on date. 40 crores is already recovered, and further recovery possibilities are there. Gold loan will come down further. Gold loan NPAs. Other recovery also, a lot of OTS settlements are given. Most of the properties are taken possession of, and we are in the process of selling. And you will see further recovery happening in the non-gold loan portfolio also. So you can expect a better recovery in the fourth quarter also.
Sure. I was also referring to the recoveries, interest write back seen due to the recoveries in Q3. The interest write back.
Naturally, write back also happens, whether it is a gold loan or a non-gold loan.
Yeah.
In the earlier days, what happened, when the recovery happens, you are appropriating the recovery to the interest first, then to the principal. Okay. Then to fall in line with the conservative accounting practices as well as the practice in the market. Nowadays, we recover the principal first and recover the interest later. So when an NPA is getting closed, most part of the recovery goes to the interest portion as the principal is already recovered. So you will see more and more income coming out of the NPA recovery.
Okay, but this quarter, what would be the quantum that is benefiting the NII line from the recovery, the interest write back?
For the last quarter, only for the quarter, 11 crores was the income from the gold loan.
Okay. Okay, got it. I'll come back in the queue for any further questions. Thank you.
Yeah.
Thank you. A reminder to the participants, anyone who wishes to ask a question may press star and 1 at this time. The next question is from the line of Nirmal Bari from Samiksha Capital. Please go ahead.
Yes, sir. Thank you for taking my question. And thanks for the detailed description that you gave about the various NIM levers that you have going forward. So my question is specifically on that right now we are anywhere between 100 and 150 basis points above what all the normal large private sector banks would be doing in terms of NIM. So that is a significant cushion in itself. So why not, and we have been saying in the previous few calls that there is very high competition from these banks and we are not compete at those price points. So why not cut down our expectation for NIM and maybe even after considering the credit cost that may come in, this 100 to 150 basis points of higher NIM cushion that we have can enable us to grow at a faster rate. So what is our thought process on that?
No, we are not against it, but in which direction we are growing is very important. Today, yes, WG rated SME account is getting taken over at 7.5%. Whether we will lend to a WG rated corporate, certainly not. There is nobody in the market who lends to a WG rated corporate. But in the SME segment, I am seeing my WG rated customers for whom I am charging 10.5% today are taken over by the leading private sector at 7.5%. I don't know the strategy. Okay, maybe they look at the overall wallet size and a lot of cross-selling possibilities and make it up somewhere else. Okay, but otherwise, pricing those loans at 7.5%, you are not taking into consideration the risk involved. I don't compete with them. I cannot not take head-on this kind of competition. I leave the accounts to do. The risk has to be priced properly. Whereas in the corporate segment, a AA-rated account comes to me at 6.5%. It was charging 9.5% at some point of time. Today, the same customer have the credit line available to them. They are willing to take it at 6.5%. I prefer the 6.5% AA-rated corporate when compared to the 7.5% BB-rated corporate. So I have grown the wholesale book. You must look at it. Quite a few accounts have been added with a good rating at a lower rate. Okay, it will happen. Similarly, in the SME also, we have considered price reduction. When we feel that the customer is worthy, we have to retail, we have done it. Not across the board. My disbursement in SME is quite high. But unfortunately, the incremental growth is low because many of the accounts got taken over by other banks at much competitive rates. I don't think that pricing is right. I would not like to compete in that market. Reducing the price so much, which will not cover the feature.
If we talk about the accounts which are outside of BB, and you gave an example of AA account, but is there sufficient opportunity available there, and are we aggressively looking to target that, as in we can let go the BB and below accounts, but above that, are we getting aggressive on the pricing itself?
That's what I was telling. Disbursements are increasing. We keep taking that kind of approach in the market. Normally, it comes from the public sector bank. Because of the delay in decision taking, these accounts are getting shifted. We price them reasonably and take it. But underpricing is not a strategy for us. There are banks which adopt underpricing as a penetrating strategy. As a small bank, we would not like to do that. A reasonable pricing should be available to us, which covers the risk involved. But there are opportunities which are growing. That is why you are saying gold loan has come to 36% and the wholesale banking has increased in the proportion.
Okay. And the last question is on advances growth for the current year. So last year in Q4, there was a significant bump up sequentially. We grew by about 10% from Q3 to Q4. So now for the so far we have grown at a decent 11% rate year on year, but then in terms of sequential, it's more or less flat. So as in from Q4 of 21, it's more or less flat. So would it be fair to assume that we would end up the year at sub 10% growth rate, or do we expect a significant bump like last year in Q4?
It appears difficult for this quarter. Last year's Q4 was extremely good. The growth was extremely good. The gold loan has grown 7% on a quarter basis. But the non-gold loan may not grow at the same level at which we have grown last year. As on date, I am not having the pipeline or the visibility for that kind of growth. First quarter could be little more flatter than the last fourth quarter. That is what I think.
Okay. And on the gold loan recovery front, you said that we had 9 crores of under recovery. So this number was for Q3 or for the first 9 months?
Sorry, come again?
You said earlier in the commentary that we had 9 crores of under recovery in the gold loans part.
Yeah. In the month of January, in the first 3 weeks, we have recorded almost 40 crores of gold loans already. Out of this 126 crores, which is outstanding in December. So further recoveries are possible in gold loan.
No, I was talking about the under recovery part. What was the quantum of under recovery in the first 9 months?
It's a deficit which happens when you sell it in the market. It is 9 crores for the last year, last 9 months. It is high because remember we adopted the high loan to asset value during the last 1 year, and the price have also fallen. So 9 crores is a deficit over a very large number of accounts. We are confident that a major portion of it will be recovered. Normally we report it as civil as a default, and this becomes an unsecured advance. But in our accounts, it is fully provided for. The entire amount of 9 crores is provided for. As and when the recovery happens, we go to reduce the provisions.
Okay. Okay, thank you. I'll come back in the queue.
Thank you. The next question is from the line of Avinash Tanawade from Dalal & Broacha. Please go ahead. Mr. Avinash Tanawade, your line is in talk mode. Kindly proceed with your question, please.
Thank you for the opportunity, sir. Just have two questions. One, in NPA addition that we have saw during this quarter, what is the proportion of a non-gold portfolio in that?
Which year of the non-gold portfolio?
Gross NPA addition that we have saw during the quarter of around 81 crores, out of which how much, what is the quantum of a non-gold portfolio?
Ganesan, can you give me this number? Mr. Ganesan?
I think locked.
Yeah.
Hello?
Yeah.
Hello?
Yeah, Ganesan.
Can you speak now? Is it audible now?
Yes, sir. You are audible.
Okay. Sir, gold loan portfolio slippage is 58.97 crores and the general gold loan slippage is 21.62 crores, totally 80.81 crores. That is the breakup.
Okay, sir. And this quarter and last quarter, we have a negative credit cost. So, looking at your business, what would be the normalized credit cost for us in medium term, near to medium term?
I don't get it.
Come again, sir?
Pardon, will you please come again?
What would be the normalized credit cost for our business?
Our credit cost is always less than 1%. Because of our aggressive provisioning policy and the change in the accounting system. RBI has stipulated, earlier days, all the return of loans when recovered is accounted as the other income. Then last quarter, RBI came out with a circular stating that the recovery from the return of account should be reduced from the provisions for the bad loans and should not be accounted as a income. Okay. So we adopted the RBI guideline immediately. But most of the banks refused to adopt that and represented to the RBI, stating that this will not show our balance sheet in good state. So please change the rule. RBI has again issued a circular now, wherein RBI has not insisted on that, but they are not discontinued that. They are not said that you can go back to the original system of accounting, but they are not insisted on accounting it as a reduction from the provision. But we continue with the same thing because it makes more sense. So as the major portion of the income from the recovery of bad debts and the return of accounts goes to reduce the provision, credit cost has come down. So long we continue with this accelerated provisioning policy and this SMA additional provisioning which we are doing, probably our credit cost could be negative for 3 more quarters unless we change the accounting policy or unless we change the accelerated provisioning policy.
Okay. And our cost to income ratio, can you elaborate more about how do we see this ratio coming down in coming quarters, and what are the steps you are taking to improve our non-interest income?
The non-interest income comes from credit-related sources and non-credit-related sources. Bank guarantee commission, LC commission, and the processing fees are related to the credit growth. When the credit growth happens, these incomes will also go up. I'm very hopeful about it. Whereas the non-credit-related items, the transaction fees, the other processing fees, other processing fees, not the loan process. So there are other fees. These things will continue to grow. We have grown in the past, only the loan-related other income has not grown. Non-loan-related other income, it will continue to grow. So when we started, 6% is a non-interest income. We calculate 20% of our income as a non-interest income at the peak. And the time return of recovery is also treated as an income. Now, the return of recovery is not treated as an income. Without that, we are at 13 to 14%. Our target is to increase it to 20% again as a percentage of total.
Okay, sir. Thank you. That's it from my side, sir.
Thank you. The next question is from the line of Aman Ilahi from Investec India. Please go ahead.
Yeah. Hi, sir. Thank you for taking my question. So my first question is with respect to the gold loan portfolio. In the last quarter, you had indicated that we have not tied up with fintechs as much as other banks have. So just wanted to check with you, have we seen some reduction in the repeat customer or rollover rates in our gold loan portfolio? Are we being adversely impacted because we are not tying up in gold loans?
No, we have a BC tie-up with the IIFL. It's going well. Other than that, other tie-ups have not happened during this period. Most of the BC companies are not willing to do it because they are getting funds at a cheaper rate. They are building their own book. Whereas the fintech companies tie-up, we are in negotiation. Nothing has been crystallized so far. We are waiting for some more time. It's all book is growing only on our own. Okay.
And so one data keeping question. What would be the size of our restructured book? And can you share the breakup between COVID restructuring and MSME restructuring?
Ganesan, can you give me the number?
Rescheduling this quarter, just a minute.
Sorry, can you repeat that?
Can you hear me? So rescheduling. So the total rescheduling is 125.13. Out of this, as per the resolution point is 2.10, we have recovered, we have rescheduled 71.39 crores. And the borrower is out of 1.0, resolution framework resolution 1.0, the rescheduling was 24.02. The others, the rest of these things are previous rescheduling as per the flood relief rescheduling, etc. The total rescheduling book outstanding as per date is 125.13 crores.
Okay.
On this, we have 25% provision. On the restructured,
we have a 25 against the required provision of 5, 10, 15 or something like that. We are making the provision of 25% as a COVID provision, standard as a provision we are keeping it for the entire amount of outstanding. And moreover, this out of this.
We are not resorted to rescheduling in the retail book. We are not resorted to rescheduling in any case for postponing the problem. These are all the genuine accounts where there was a demand for restructuring from the client, putting the deferment of income, which we are considered. So it is a very small book. And on that also we have 25% provision. Nothing to worry. I was reading some credit agencies' report where they say that when the restructuring period comes to an end, there will be a surge in the NPA for the banking industry. In our case, nothing of this sort will happen. But anyway, we are treated it as NPA, and we are provided much more than what the NPA provision requires.
Thanks for that. Lastly, I'd like to congratulate you on the tremendous job you have done since joining. But just wanted to get your sense on how big of a challenge is it going to be for whoever replaces you to handle this current standoff that we are having with the union. So I understand, the size of the IBA employees in our overall employee pool is low, but we every year now and then we keep hearing about strikes and banks function being impacted, specifically in the state of Kerala. So just wanted some thoughts from you on how big of a challenge do you see for whoever comes in your place.
Actually, the unionized employees are no more a challenge in the bank. As you have given the number, there are hardly 1,365 unionized employees, out of which 50% are only clerks and pions, and sweepers. There are about 600 odd offices. Most of them are cooperating with the management. Only about 100 people may not be in good terms with the management. So they are minuscule in the number. Out of the 5,000 employees, Not even about 500 employees are really Indianized in the sense, have that kind of a militant attitude. So these guys are all posted to the remote branches in Kerala, which is not contributing much for our business. If we take 20% of our top branches, all the top branches, about 200 branches are manned by efficient internal people or people who have come from the lateral recruitment. So even when there was a nationwide strike, there are only 3 remote branches which are closed because we were not able to arrange the substitutes. Otherwise, every other branch is open. Even when there was a national level strike at all private sector banks under the CSB Bank, our branch was functioning like any other new private sector bank. So strike has much lesser impact on us when compared to any other old private sector bank. Whatever strike happens, whether it is national level strike or industry level strike or a bank specific strike, all our branches are kept open and running business as usual. So that has no impact at all. Anyway, we keep negotiating with the employees. Again, they have come to the negotiating table. The fact that I am moving out created some anxiety in them. They wanted to settle it because understanding is better at our level. So we are negotiating with them. Hopefully, we may arrive at a settlement before I leave. That is the proposal. But even if I leave without settling it is not an issue. There are internally people who can help us the next successor to manage it. It's not an issue anymore.
Right. Thank you, sir, and I wish you all the best for your return.
Thank you.
Thank you. Before we take the next question, a reminder to the participants, in the interest of time, you may be requested to limit your questions to 2 per participant. The next question is from the line of Jayan Bada from Nirmal Bang. Please go ahead.
Good morning, sir. Sir, it was just discussed in the call that gold slippages for Q3 were at 59 crores, which works out to around 4% kind of slippage ratio. So is this normal? I think it is on the higher side, right? So why are we seeing this slippage still on the higher side in a good environment also in Q3?
I'm not getting it. 59 crores, how it becomes 4%? 59 crores will come to 1% of net worth, right?
Of your gold portfolio?
Gold portfolio is 6,000 crores.
Okay. Yeah. Right. Sorry. Okay.
So slippage is very low, but slippages do happen, right? Not every loan is paid on due date. Slippages do happen, then you take the steps to recover it. And 90 days time is there to afford it as an NPA. Before that, most of the accounts are closed. And even if it is beyond it, there is not much of a rate. Today, at the portfolio level, my loan to asset value is only 75%. You remember, 90% lending was there at some point. Today, all the loans are rolled over, and today my loan to asset value is 75%. I'm sure by March end, my loan to asset value for the portfolio will come to 70 to 72%. Okay. It's a more comfortable position. There could be some outlay, few accounts that gone up. That is where the forceful recovery is happening. I'm sure even that problem should be sorted out in March. I remember we never discussed NPA in gold loan in the entire 5 years, except the last 1 year. Last 1 year is a tough year, high loan asset value. Right. But that only has given the growth to the banks, which is growth is 3 times instead of all the problems addressed. And we were able to address all the problems and come out of it. Okay. It could have been addressed in the first quarter itself, not for an aggressive sale in the auction. All the problems could have been addressed. But I might have lost my customers, and many of the families might have cursed me for having so much jewelry. These are the lower end of the middle class. Once you sell the jewelry in the auction, they will never acquire it again. So when we give an auction notice, when people come running saying that, sir, I would like to retain it, we ask them to pay at least a portion of the interest to show their interest in redeeming the jewelry. If that is coming, we waited for. We waited for quite some time. We enabled customers to redeem the jewelry by themselves instead of selling it in the auction. By selling in the auction, I would have lost by brand value, and customers will not come back to this bank again. Yes, by not resorting that kind of recovery action, we have generated so much of goodwill in the market today. The customers talk about it. This is one bank which will not sell our jewelry in a hurry. In tough times, there will be some leeway for us to redeem it. That we are able to create, that is reflecting what is happening now. The third quarter, we have grown 7% on a quarter-on-quarter basis. So I think that's the right decision, and we are not lost to bank on that.
Right. And sir, you feel this is a temporary phase because, like as you said, this is 1%, 59 crores is 1%, but if I'll annualize it, it becomes 4%. So that was no?
That's what I'm saying. On an ongoing basis, every day, 3,000, 2,000 accounts are maturing, and most of the accounts, maybe 1,000 accounts are not paid up to date. The recovery action starts from there. Within a month, 2 months, most of the accounts are closed or rolled over. The 90 days time is sufficient to recover. Okay. So even if it is there, if the loan asset value is low, you earn 2% more on that. Okay. Customer comes back and pays. Now, if the loan asset value is reasonable, loss possibilities are very less in the gold loan business, and NPA is just a number, nothing more than that.
Got it. Okay. And sir, on the non-gold side also, now our slippages are at a very low level since last couple of quarters. So still our loan growth is not accelerating. So any particular reason or any timeline if you can give by when we expect non-gold loan growth?
Industry as a whole loan growth is not very impressive. Okay, we are not bad. For the first 9-month basis we compare, our growth is much better than the industry level. But I don't want to compare with I'm a small player. Considering a small base, we should grow much better. That is our ambition also. But you look at the wholesale banking portfolio doesn't give much. Okay. And I have my own limitations on taking exposures on wholesale banking. I don't take more than 100 crores at the entry level. 100 crores is too small for many of the corporations in this country. So getting a share in the wholesale banking is always a challenge for a small bank like ours. The SME, the risk is not getting priced properly. So unless we get the proper pricing, we don't push the SME advances. In the retail, as per the financial stability report, 63% of the growth has happened only in the housing loan and the personal. We are not in the housing loan market because the margins are low. Recently, we reintroduced our housing loan product and start selling it to fulfill our product bouquet, but not aggressively, because there is no margin in housing loan business. So on the other hand, it is personal loan. Personal loan is an unsecured loan. We are ready with our product. Our retail department has launched the retail loans, but we are not sold it aggressively because we thought the timing is not right yet. Once the Omicron is over, probably we can go for aggressive credit expansion. You should not be aggressive in a market like this, and where there are so many uncertainties. That is the call which management has taken.
Right. Okay. And sir, last question, are we open to a possibility of any acquisition or merger with any bank or NBFC?
That is always a possibility. We keep exploring. We were waiting for this CSO privatization. Somehow it is getting delayed. If that is not happening, probably we'll look at the other candidates also in the market.
Okay, fine. Thank you, sir. Thank you so much.
Thank you.
Thank you. The next question is from the line of Parthiv Jonza from NVS Brokerage. Please go ahead.
Good morning, sir. Thank you for the opportunity for me to participate today. So before I ask any question, I would like to congratulate the team at CSB, who has done an exceptional job over the last few years, and the same is actually visible in all your quarterly numbers, which are better than the previous one actually. So my questions, I would just restrict myself to two questions. A quick question. The first is, sir, our cost to income, which stands at 58.5% right now. However, a couple of quarters back, you had guided, for a cost to income to reduce below this 50%. Just want to check by when can this be achieved? And the second question is, sir, with January 22 almost about to end in this week and only 2 months left, usually we have seen that quarter 4 is the best quarter in the industry. Can you guide us on how will we close the number in terms of top line and the profitability for this current year?
So as far as the profitability is concerned, the Q4 could be much better.
Hello, sir. Your voice is not audible, sir. Hello.
As far as the quarter four profitability is concerned,
Yeah.
it should be a great quarter. The recoveries are going to continue. And
Okay.
So,
Okay.
from the profitability point of view, it should be good. Cost of funds will go down further, and yield on advances will go up further.
Okay.
These are all the possibilities. Profitability also. As far as the
Sure.
cost income is concerned, we have opened 152 branches during the last 1 year.
Okay.
These are the branches which we have furnished. We have done the IT assets and all, and people also. They have not achieved the critical mass.
Okay.
Break-even point level has not happened.
Okay.
And, we have given 1 year as a break-even for most of the branches.
Okay.
Average age of this branch is only 9 months as on date. They already contributed about 1,200 crores by way of additional business. It is a very good number. But yet, it is not a fuller capacity.
Okay.
It takes some more time for us to reach the break-even level. Then the branch is a short contribution. Similarly, we have recruited more than 3,000 people in the lateral recruitment. They are not reaching their full potential. Okay. So they are settling down. There are a lot of attrition is also there. So naturally, the productivity of the people has not come to the desired level.
Okay.
Per branch is remaining at around 50 to 65 crores. So the competition is between 140 to 230 crores.
Okay.
So the branches can double the business or triple the business with the same overhead and same staff cost.
Okay.
So naturally, the scope are going down below 30. But in 1 quarter, we have gone down below 47 also.
Yes, sir.
But this may not happen in a hurry. The volume growth happens naturally. We will move 40%. I'm very confident.
Okay. Thank you. Thank you so much. That helps a lot. Thank you and best of luck, sir.
Thank you. The next question is a follow-up from the line of Mona Khetan from Wallet Capital. Please go ahead.
Yeah, hi, sir. Thanks for taking up my questions again. Just 2 clarifications. So on the gold segment, your yields have continued to rise even this quarter, despite the the competitive environment in this segment. So what is helping the rise in yields in this segment?
What is help us driving?
The gold loan yields are higher sequentially, right? From 12.5 to 12.7 or thereabouts. The lending yields.
The lending, there is a customer for every price point in the gold loan. The public sector banks are giving at 4%. There is a customer base for it. They are also growing. There are private banks which are lending at 10%. They are also growing. There is a customer base for it. There are private banks which are lending between 12 to 15%, and they have their own collateral base. There are NBFCs which are lending between 24 to 36%. There is a collateral base for it. How do you package the product? The average ticket size of the loan and the convenience, turnaround time, in the targeted market segment. These things decide your pricing ability. When the ticket size goes down, your normally rate increases. And when you have a quicker turnaround time and the efficiency is good, you get more customers working into the bank. We have improved our turnaround time a lot. That helps us a lot. Of course, our ticket size is around 1.3 per loan, whereas the gold loan companies are around 50,000 rupees. So naturally, more retail marketing is to be done to get more share from the gold loan companies and maintain the yield. That is where we have taken a lot of sales force down. The gold loan sales officers are. With their help, I'm sure that we will build a portfolio which is high yielding and low in ticket size. Okay, of course, naturally, the cost of operation will be slightly more, but that is also a focus now. We are trying to reach out to this segment. Similarly, we are trying to go on a blue ocean strategy to reach out to customers who are not the gold loan customers so far. The middle class people who are not borrowing on the gold, we are trying to reach out and try to, because many of them are not getting personal loans now. So they are willing to for a gold loan. If that segment happens, your average ticket size can move to 3 lakhs. It's certainly a little lesser rate. but cost of operation will be different. So these are all online customers. So we are taking both efforts depending upon in which direction the growth comes. Either yield can go up or volume can go up. That is a possibility.
Sure. And your average ticket size currently is about 1.3 lakhs.
About 1.3 lakhs per kilo.
Okay. And just finally, what would be your SMA book today?
Come again, SME?
Special mention account, SMA book, where would it lie, including the 012 book? It was about 2.6% last quarter. So,
Slippage ratio in SMA you are asking?
No, SMA ratio in your standard book, how much would be DPD 0?
Right. I got it. SMA has come down drastically. So as a result, we could have returned back 27 crores. On SMA also, we are providing 25%. For one day slippage, one day default, we provide 25%. As such, SMA book was very big. You see, it was about 400 crores earlier. It has come down to less than 300 now. So roughly about 286 or something like that. As a result, there is a huge excess provision in the SMA, which we are not reversed. The NPA, the excess provision was reversed after accounting for accelerated provisioning. In the SMA, we are not reversed the provision. In fact, today, SMA accounts are carrying much larger provision than the NPA accounts in the bank. Now, this is only a temporary provision which we have created for meeting the COVID situation. And once the COVID is over, we're confident that COVID is not a problem anymore. We will be in a position to reverse it. About 105 crores is sitting in the SMA provision, as against the 286 crores of SMA book. So SMEs are good. Even the data, if I remember correctly, in the presentation, we have given the 5-quarter data for SME segment also.
Sure. Thank you. That's helpful. And all the best, sir.
Thank you. As there are no further questions, I now hand the conference over to the management for their closing comments. Over to you, sir.
Thank you. Thank you for patient hearing in the early morning. The last time when we were explaining, of course, this gold loan NPAs were taken very seriously in the market. We were explained. I was on the borrower side, then on the investor side, as far as the gold loan NPA was concerned. That given us good yield and we were able to recover the loan what we lost, and the book has also started growing. So that is no more an issue. By March end, the entire gold loan NPAs will be completely recovered, and we will not discuss gold loan NPAs in any of the future quarterly results. As far as the SMA book is concerned, it has started growing, and wholesale banking book, as we always explain, is only parking off our funds for a temporary period. So all these loans have a repricing option and call option end of 6 months. Call and put option for both sides. So when the rates go up, I will be in the position to reprice the loans, or the customer is not willing, he will be in the position to repay the loan also. So the liquidity is not a problem for the bank. It is only the asset growth which continues to be a challenge for us. So when the asset book grows, I am confident we will be in the position to increase the margin. Every 1,000 crores of asset book growth, somewhere about 40 to 45 crores will be the additional contribution to the profits. That is my share of calculation. So bank will grow. So hereafter, the volume has to grow. We are comfortable that the adversities in the markets have moved out. We will certainly become aggressive in the retail lending market and SME market, which should help through the front book. But to let you know the impact of accelerated provision. But when we talk about accelerated provisioning, additional provisioning for COVID, we are not able to quantify. For the past 2 days, many people are calling me and asking me. Even I have not done it. But this time we have provided it as a pro forma data. Had we not provided this extra provision, had I built my accounts like any other bank, as per the RBI regulation alone, what could be the profit for the bank? We are shown in our presentation, and it will be uploaded in the website today. That is very impressive. The profit should have been about 504 crores for the 9-month period. That is the number. And similarly, EPS, return on assets, and return on equity, everything moves up. So that's a interesting one to read. Thank you. If there is any further questions, you can call us, any one of us, and we'll be happy to help you out with the numbers.
Thank you. Ladies and gentlemen, on behalf of Axis Capital, that concludes this conference. We thank you all for joining us, and you may now disconnect your